In the world of trading, most people search for the perfect setup, the perfect indicator, or the perfect strategy that will finally eliminate uncertainty. But the deeper truth is far more subtle, yet far more powerful. A trade becomes successful long before you press the buy or sell button. It becomes successful in the space where beliefs are formed, where expectations are shaped, and where your interpretation of the market defines how you interact with it. The real secret formula has nothing to do with predicting what the market will do next, and everything to do with how you respond to what the market is already doing. Every trader enters the market with a different mental map, shaped by wins, losses, fears, hopes, and the emotional residue of past decisions. These mental filters shape each decision, often without awareness. What some traders call a signal, others see as a trap. What some call risk, others view as opportunity. The chart is the same, the candles are the same. The only difference is the internal dialogue behind the trader's eyes. This is why success is not found in the strategy itself, but in the mindset that executes it. The secret formula begins with accepting that every moment in the market is unique. No two patterns, even if identical, carry the same meaning or the same probability. When you embrace this truth, you stop expecting certainty and start operating based on probability. This shift is the beginning of real consistency. A trader who is grounded in probability stops reacting emotionally when the market turns unexpectedly. Instead of being surprised, they understand that anything can happen, and they welcome this uncertainty with calm neutrality. Another essential component of the formula is cultivating a mindset that allows you to follow your rules flawlessly. Most traders have rules, very few apply them without resistance. The conflict between what the market is showing and what the trader wants to happen is the source of hesitation, fear, revenge trades, and premature exits. To eliminate this conflict, you must align your beliefs with the realities of the market. The market doesn't reward effort, intelligence, or intensity. It rewards objectivity, emotional neutrality, and disciplined execution. When a trader finally understands that outcomes are not personal, they stop internalizing losses and start seeing them simply as part of the probabilistic structure of the game. The secret formula is completed by mastering the art of detachment. Detachment from the outcome of any single trade. When a trader no longer feels emotionally threatened by loss, they free themselves to operate with clarity. This clarity allows them to see opportunities others distort with fear or greed. It creates a state of mind where the market's flow becomes more visible and decisions become more precise. You don't control the market, you only control your response to it. And it's this response, rooted in awareness, neutrality, and disciplined execution, that becomes the foundation of successful trading. Every market moment is unique because the market is a living reflection of collective human behavior. Millions of decisions, emotions, expectations, and reactions occurring simultaneously. No single candle, pattern, or price level carries the exact same context as any other moment in the past. Even if the chart looks identical to a previous scenario, the psychological environment behind it is always different. Traders are different, liquidity is different, time conditions are different, and broader influences are never the same. Understanding this is the foundation of trading mastery because it frees you from the illusion that certainty exists in the market. Many traders fall into the trap of believing that patterns repeat with guaranteed outcomes. They search for the perfect signal, the perfect confirmation, or the pattern that worked last time and assume it must work again. But what they are really chasing is emotional comfort, not true edge. A pattern may resemble something you have seen in the past, but the forces driving it now may be entirely unrelated. The participants reacting to that price level today do not share the same motivations as the participants months or years ago. Some are institutional traders defending positions. Others are new retail traders acting from fear or excitement, and others are algorithms reacting to volatility. These variables make the current moment completely separate from any historical reference. Once you internalize that every moment is unique, you stop expecting the market to behave in a predictable, mechanical way. Instead, you start recognizing that your job is not to find certainty, but to manage probabilities. This is a psychological shift that separates professional traders from those who depend on hope. When you believe that a pattern must work because it worked before, you make the market responsible for your expectations. When you accept that each moment is independent, you take responsibility for adapting to what is actually happening, rather than what you wish would happen. This understanding also removes the emotional attachment to past trades. Many traders carry emotional baggage from earlier wins or losses into the present moment. assuming that a winning streak guarantees another win or a losing streak signals another loss, but neither belief aligns with the truth of the market. A winning streak does not increase your probability of success on the next trade, nor does a losing streak decrease it. The market does not remember your last trade, only you do. When you let go of this attachment, you operate from a clean slate where each decision is based solely on what the market is showing right now. Accepting the uniqueness of each moment helps silence internal conflicts. When traders assume that a pattern should work, they create friction between reality and expectation. This friction turns into hesitation, fear, or overconfidence, all of which distort perception. A trader might see a breakout and assume it must continue because similar breakouts were successful in the past, thereby ignoring signs of weakness. Another trader might see the same breakout and expect it to fail because they were just stopped out earlier, causing them to hesitate. These emotional biases arise from expectations tied to previous experiences, not from the truth in front of them. When every moment is viewed as unique, there is no pressure for the market to repeat its old behavior. This perspective leads to emotional neutrality because you stop interpreting market movement through the lens of past pain or pleasure. You see what is present, not what your memory or ego wants to imprint onto the chart. You become more objective, more flexible, and aware of what the market is communicating now. This neutrality is essential for consistent decision-making as it prevents biases from filtering your perception. Another important aspect of recognizing the uniqueness of each moment is the freedom it gives you to take trades without emotional burden. Many traders hesitate to enter trades because they are anchored to the memory of a loss that occurred in a similar situation. They fear that history will repeat itself. Others enter trades recklessly because they are anchored to the memory of a big win and expect the same result. Both behaviors stem from assuming that the past dictates the present. But once you truly understand that every moment stands alone, you no longer project past experiences onto current opportunities. This frees your mind to assess the market with clarity and confidence. This principle also impacts stop loss and target expectations. Traders often place stops or targets based on what worked previously, assuming the market will react the same way. But the market has no obligation to repeat its behavior. Liquidity conditions change, volatility shifts, and institutional behavior evolves minute by minute. When you understand this, you stop placing stops and targets based on comfort and start basing them on evolving market structure. You become less rigid and more adaptive, which is essential for long-term consistency. Recognizing the uniqueness of each moment also protects you from overtrading. Many traders chase trades because they believe that missing a move now means missing a rare opportunity. But when every moment is unique, you understand that new opportunities arise constantly, each with its own probabilities and conditions. You no longer feel pressured to participate in every move. This reduces impulsive decisions and increases selectivity, which strengthens discipline and performance. Furthermore, this mindset helps eliminate the destructive cycle of revenge trading. When traders believe that the market wronged them in a previous moment, they return with emotional retaliation, trying to get back what was lost. But revenge trading is rooted in the illusion that the next moment is connected to the previous one. Once you accept that each moment is independent, you stop personalizing outcomes. You no longer feel the need to make the market repay you because you realize the market wasn't responsible for your emotional reaction. This realization dissolves a huge source of psychological pressure. The uniqueness principle also enhances risk management. When you believe every moment is different, you stop expecting the perfect trade and instead prepare for multiple outcomes. You size positions based on risk tolerance, not on confidence or excitement. You understand that even the best setup can fail because the context behind it is never identical to the past. This makes your approach more defensive, balanced, and sustainable. Most importantly, understanding that each moment is unique creates mental freedom. It removes the burden of predicting the future and replaces it with the responsibility of responding to the present. It shifts your mindset from control to acceptance, from fear to observation, and from emotional trading to probabilistic decision-making. Trading based on probabilities rather than predictions is the cornerstone of developing true consistency in the markets. Most traders enter each trade hoping they know what will happen next. They analyze charts, compare patterns, follow indicators, and then try to convince themselves that the market will follow their expected direction. But the market does not reward certainty, it rewards alignment with its inherent uncertainty. Predictions are attempts to impose personal expectations onto a dynamic environment, while probabilities acknowledge that the market can move in any direction regardless of what you believe. When you shift from prediction-based thinking to probability-based thinking, you change the entire structure of how you interact with the market. A prediction says, this will happen. A probabilistic mindset says, this can happen. That single shift removes emotional attachment from outcomes and replaces it with statistical understanding. When a trader operates through predictions, every deviation from expectation creates stress, fear, frustration, or confusion. They feel betrayed when a perfect setup fails or when the market suddenly reverses. But a trader grounded in probabilities expects variability. They know that even high-quality setups come with losing outcomes because the market's behavior is not fixed. This mindset transforms losses from emotional events into routine parts of the process. Trading based on probabilities begins with accepting that no setup offers 100% certainty. Every pattern, signal, or indicator is merely a representation of tendencies, not guarantees. A breakout pattern has a probability of continuation, but none of the factors ensure it must continue. A support level has a history of holding, but the market has no obligation to respect that history. When you internalize this truth, you stop judging your trades solely by the results and start evaluating them by how well they adhere to your rules and edge. A prediction-based trader ties their self-worth to the outcome of each trade. They feel validated when correct and defeated when wrong. Their emotional stability fluctuates with every winning or losing position. A probability-based trader, however, sees each trade as one event among thousands. They understand that no single trade defines their skill, identity, or future. The only thing that matters is whether their decisions align with the statistical advantage they have identified. This perspective creates stability, reducing the emotional roller coaster that destroys many traders' discipline. Another core element of probability-based trading is consistency in execution. When traders operate through predictions, they often break rules when they feel confident or fearful. They may enter too early, exit too late, or skip setups because of emotional bias. With a probabilistic mindset, rules become non-negotiable. The trader understands that rules are designed to extract long-term edge from the market, not to guarantee the outcome of an individual trade. Following these rules consistently is the only way to realize the advantage hidden inside the probabilities. Probability-focused traders also manage risk differently. Instead of increasing position sizes when they feel a trade will work, they maintain consistent risk because each trade is simply another event with uncertain outcomes. They size positions based on the overall system, not personal conviction. This prevents catastrophic losses that often occur when traders try to force the market to behave according to their predictions. A probability-based trader never tries to make the market bend to their expectations. They adapt to the market structure. One of the most powerful transformations that come with embracing probabilities is the removal of emotional resistance. Fear, greed, hesitation, and revenge trading all stem from the expectation that the market should behave in a particular way. When the market does not move according to prediction, the trader feels threatened. When probabilities guide decisions, there is nothing to be threatened by. If the trade loses, it simply fell into the losing side of the statistical curve. If it wins, it aligned with the favorable side. Either result fits into the structure the trader expects. This mindset also affects how traders perceive streaks. A prediction-based trader sees a losing streak as proof that something is wrong or that the market is unfair. They may panic, abandon strategies, or try to win back losses impulsively. A probability-based trader recognizes streaks as natural mathematical outcomes. They understand that even strategies with strong edge will experience sequences of losses, just as a fair coin can land on tails several times in a row. This understanding protects them from emotional overreaction and helps them maintain stability during challenging periods. Probabilistic thinking also enhances patience. Traders who rely on predictions often chase trades because they fear missing the next big move. They feel the market owes them a winning opportunity and jump into setups that don't truly fit their rules. Those who trade with probabilities wait patiently for their high-quality conditions to emerge. They know that their edge reveals itself only when they operate within a specific structure. This patience reduces overtrading and leads to higher quality decisions. Another key aspect of probability-based trading is the acceptance of randomness. Randomness does not mean chaos. It means that outcomes distribute themselves over time in unpredictable sequences. A trader committed to probabilities respects this randomness and structures their strategies around it. They focus on sample size rather than individual outcomes. Instead of obsessing over whether one trade will win, they remain focused on the next 100. This shift in focus builds resilience because the trader no longer reacts emotionally to short-term fluctuations. When you operate in probabilities, the market becomes a series of opportunities rather than battles. You stop fighting for certainty and start operating within the flow of potential outcomes. This reduces psychological tension because you are no longer in conflict with the market. You are aligned with its true nature. You make decisions from a place of clarity rather than from a place of fear or hope. You become more observant, more strategic, and more disciplined. A probabilistic mindset also improves adaptability. When conditions change, volatility increases, trends slow, ranges expand. A prediction-based trader feels lost or confused because their expectations no longer align with reality. A probability-based trader adjusts easily. They analyze the present environment and modify their approach according to the new probabilities. They don't cling to outdated expectations. They evolve as the market evolves. Ultimately, trading based on probabilities transforms the trader's internal world. Instead of being driven by emotion, they become guided by structure. Instead of reacting impulsively, they respond intelligently. Instead of seeking certainty, they embrace uncertainty and use it to their advantage. This is the mindset that creates consistent, long-term success in the market. Emotional neutrality is one of the most misunderstood yet essential components of consistent trading. Many traders assume that controlling emotions means suppressing feelings or pretending not to care, but emotional neutrality is far deeper and more refined than that. It is a mental state in which the trader's decisions are completely unaffected by fear, greed, hope, frustration, or excitement. It is the ability to see the market exactly as it is without adding personal meaning, emotional noise, or psychological baggage to price movements. This state of mind allows traders to execute their strategies with clarity, precision, and confidence, even when the environment is uncertain or volatile. Most trading problems originate not from a lack of knowledge or technical skill, but from emotional interference. A trader may have a solid strategy, a clear set of rules, and a defined edge, but the moment emotions enter the equation, execution becomes inconsistent. Emotional impulses override logic, fear whispers that the trade will fail, greed pushes for oversized positions, hope delays exits, regret leads to hesitation, overconfidence encourages risk-taking. All of these emotional reactions distort perception, shift focus away from the actual market conditions, and create internal conflict that leads to mistakes. When a trader is emotionally neutral, none of these forces interfere with the decision-making process. Emotional neutrality begins with removing personal meaning from market outcomes. Traders often internalize wins and losses, treating them as reflections of their intelligence, skill, or worth. A winning trade boosts their ego, while a losing trade triggers insecurity. This creates a cycle in which the trader is emotionally tied to outcomes, causing them to overreact to short-term results. Emotional neutrality removes this attachment. The trader sees each trade as nothing more than a probability-based event. Wins and losses become data points, not emotional experiences. This shift in perception immediately reduces anxiety, pressure, and self-judgment. Another aspect of emotional neutrality is accepting that the market is not predictable. The desire to know what will happen creates tension. Traders want certainty, and when they don't get it, they react emotionally. Fear arises when the market moves against them because they believed it should go the other way. Anger appears when a stop loss is hit because they expected to win. Emotional neutrality comes from fully accepting uncertainty. When a trader understands that anything can happen, they stop trying to control the market and focus instead on controlling their actions. This acceptance creates a calm mental environment where decisions are based on observation rather than expectation. Neutrality also requires detaching from the outcome of any single trade. Emotional traders view each trade as significant. They fear losing money, missing out, or being wrong. This pressure leads them to force trades, move stops, take profits too early, or hold losers too long. An emotionally neutral trader treats every trade as just one of many. They understand that no individual trade matters as much as the collective performance over a large sample. This detachment reduces emotional stress and allows them to follow their rules consistently without being swayed by short-term fluctuations. A neutral emotional state makes it easier to follow a trading plan with precision. Most traders break their rules not because they don't understand them, but because emotions cloud judgment. A trader may see a setup but hesitate because of a previous loss. This hesitation has nothing to do with the market, it is entirely emotional. Another trader may break risk management rules because of excitement after a winning streak. Again, emotion, not logic, is in control. Neutrality removes this internal conflict. Without emotional interference, the trader sees the setup clearly, recognizes its validity within their strategy, and executes it without hesitation or force. Emotional neutrality also enhances perception. Emotions distort what traders see on the chart. Fear makes them see threats everywhere. False signals, imagined dangers, potential reversals. Greed blinds them to warning signs and encourages unrealistic expectations. Frustration creates tunnel vision, causing traders to miss important clues. Neutrality creates mental clarity, allowing traders to interpret price action objectively. They see the actual behavior of the market, not the version filtered through emotional bias. This clarity improves decision-making and timing. A key part of achieving neutrality is understanding that emotions are triggered by beliefs, not market movement. The market does not cause fear or greed, the trader's interpretation does. If a trader believes losing is unacceptable, every loss feels painful. If they believe markets should behave a certain way, deviations create frustration. If they believe profits must be protected at all costs, they exit trades prematurely. Emotional neutrality requires examining and reshaping these beliefs. When a trader adopts beliefs aligned with the market's realities, such as accepting risk, embracing uncertainty, and understanding probabilities, the emotional charge behind decisions fades. Neutrality also plays a major role in handling unexpected events. Sudden spikes, sharp reversals, missing a move, or being stopped out all create emotional reactions in traders who are not mentally grounded. They may freeze, panic, or react impulsively. A neutral trader, however, sees these events as natural expressions of market structure. They do not feel threatened by volatility. They remain calm and respond according to their plan. This calmness is not a lack of emotion, but a balanced state where emotions do not dominate behavior. Another dimension of emotional neutrality is the ability to remain stable during both winning and losing streaks. Many traders believe neutrality is only needed in times of fear, but winning streaks can be equally dangerous. Success creates excitement, and excitement leads to overtrading, increased risk, and impulsive decisions. Emotional neutrality keeps the trader grounded. It prevents them from becoming euphoric during wins or discouraged during losses. They maintain a consistent mindset regardless of short-term outcomes, allowing for long-term stability. Neutrality also reduces the urge to chase trades. Emotional traders feel compelled to act whenever the market moves quickly. They fear missing out, and this fear drives impulsive decisions. Neutral traders have no attachment to catching every move. They wait for the setups defined by their edge. This discipline comes naturally when emotional impulses are quiet and decisions are grounded in logic rather than reaction. The development of emotional neutrality is closely tied to self-awareness. Traders must learn to recognize emotional triggers: fear before entering, nervousness during drawdowns, frustration after losses, overconfidence after wins. These triggers do not disappear through force, but through understanding. When traders observe their emotional patterns without judgment, they weaken their power. This internal awareness leads to greater control, which gradually transforms into neutrality. One more important aspect is avoiding personal narratives. Traders often create stories around their trades. The market is against me. I always lose at the worst time. This move owes me something. My luck is bad. These narratives fuel emotional turbulence. Neutrality eliminates personal interpretation. The market is simply the market, and trades are simply trades. Without narratives, emotional pressure dissolves. Emotional neutrality is not achieved through willpower. It is cultivated through repeated exposure to uncertainty, conscious acceptance of risk, adherence to rules, and a disciplined focus on the process rather than the outcome. It grows as traders realize that their emotional reactions are optional and that clarity comes from letting go of personal attachment. Through this neutrality, trading becomes more structured, more objective, and more aligned with the true nature of the market. Detaching from the outcome of each trade is one of the most transformative shifts a trader can make. Yet it is also one of the most challenging because it requires a complete reorganization of how the mind interprets risk, uncertainty, and personal identity. Most traders unconsciously attach emotional significance to every individual trade. They view each position as a test of their skill, intelligence, or worth. They believe that a winning trade proves something about them, and a losing trade takes something away from them. This creates intense psychological pressure, and it is this pressure, not market movement, that leads to impulsive decisions, inconsistent execution, and emotional instability. The moment a trader detaches from the outcome of a single trade, they liberate themselves from this burden and create the mental space necessary for consistency. Detachment begins with the understanding that no single trade matters in the larger context of a trading career. Each trade is simply one event in a long series of events with a random distribution of wins and losses. Even the best system, the best analysis, or the best strategy will produce losing trades because losses are built into the structure of probabilities. When a trader attaches emotionally to each outcome, they forget this truth. They feel the need to be right rather than the need to follow their edge. The desire to be right becomes the root of hesitation, fear, revenge trading, and premature exits because the trader is trying to avoid the emotional discomfort of being wrong. Detachment dissolves this need to be right. It allows the trader to follow the plan without fear because their identity is no longer tied to the result. A trader who is attached to outcomes experiences amplified emotions. They feel anxiety before entering a trade, constantly questioning whether it will win. They feel tension during the trade, watching every tick and interpreting small fluctuations as threats or promises. They feel disappointment or frustration after losses, which then affects the next trade. This emotional involvement creates a reactive mindset where decisions are clouded by internal noise rather than guided by objective analysis. Detachment quiets this noise. When the trader no longer needs a specific trade to work in their favor, their mind becomes free to observe what the market is actually doing. They become more present, more rational, and more aligned with the reality of the moment. Detaching from outcomes also enhances discipline. Most traders break their rules not because they lack knowledge, but because they are emotionally attached to the trade. They move stop losses because they hope the market will turn around. They close winners too early because they feel the need to secure a profit. They avoid valid setups after a loss because they fear another failure. All of these behaviors come from attachment. When the outcome of a trade loses emotional significance, there is no reason to modify rules impulsively. The trader becomes able to execute the plan as designed, knowing that a single outcome is irrelevant compared to the long-term edge. Another powerful benefit of detachment is the reduction of psychological resistance. Resistance appears when the mind tries to avoid discomfort. For traders, discomfort often comes from uncertainty, loss, or the possibility of being wrong. When a trader is attached to outcomes, they resist taking trades that match the plan because they fear losing. They resist exiting losing trades because they cannot accept the emotional impact of taking a loss. They resist letting winners run because they fear a reversal will take away the profit they emotionally value. Detachment removes this resistance by shifting focus from short-term emotional comfort to long-term consistency. Detachment is also essential for managing risk effectively. Traders who are attached to outcomes tend to increase risk when they want to win more and decrease risk when they are afraid of losing. This emotional fluctuation in position sizing disrupts the mathematical foundation of their edge. A detached trader, on the other hand, sees risk as a fixed cost of doing business. They understand that risk must remain consistent for the probabilities to play out. They accept the loss when it comes, not because they enjoy losing, but because they understand that loss is a natural part of the distribution and carries no personal meaning. One of the most damaging effects of outcome attachment is revenge trading. When a trader takes a loss personally, they feel compelled to recover it quickly, as if the market has taken something from them. This emotional reaction leads to impulsive decisions that often cause even greater losses. Detachment eliminates the emotional need for revenge. Without personal attachment, a loss is simply a statistical event, not a personal attack. The trader moves forward without internal conflict, waiting for the next valid setup instead of trying to force a win. Attachment also creates illusions of control. Traders often believe that if they analyze deeply enough, wait long enough, or interpret charts cleverly enough, they can ensure a winning outcome. This belief creates frustration when the market behaves unpredictably. A detached trader does not seek control. They accept that they cannot influence the market. Their focus shifts from controlling outcomes to controlling actions. This distinction frees the trader from unrealistic expectations and allows them to operate with emotional calmness and psychological balance. Detachment is equally important during winning periods. Success can be as dangerous as failure when a trader is emotionally attached to outcomes. A series of winning trades can create overconfidence, leading the trader to take larger risks, enter trades that do not meet their criteria, or ignore proper management. Detachment protects the trader from the emotional highs of success. They do not feel invincible after a win, nor do they feel entitled to continued success. Each trade remains just another event within the larger probability framework, preventing ego-driven decisions. Detaching from outcomes also helps the trader remain adaptable. Markets are dynamic, evolving environments. A trader attached to outcomes often becomes rigid, forcing the market into patterns that fit their expectations. When the market behaves unexpectedly, they feel threatened and react emotionally. A detached trader adapts more easily. They accept new information without defensiveness and adjust their strategies as conditions change. They remain flexible because they are not emotionally invested in a specific predicted outcome. Another important element of detachment is recognizing that the market does not owe anything to anyone. Traders often feel entitled to a win after a string of losses, or expect a pattern to work simply because it worked before. This sense of entitlement is a form of attachment. When the trader lets go of these expectations, they stop projecting personal desires onto the market. They see price action objectively, responding to actual conditions rather than imagined obligations. Detachment also improves focus. When the mind is not consumed by fear or hope, attention becomes sharper. The trader can analyze the market with greater clarity, recognizing patterns, shifts in momentum, and structural changes without emotional distortion. This heightened focus leads to better timing, more accurate entries, and cleaner exits. Finally, detachment supports long-term sustainability. A trader who is emotionally entangled in every outcome will burn out mentally and psychologically. The constant pressure, highs and lows, and emotional swings drain energy and motivation. A detached trader experiences none of this turmoil. Their process becomes steady, calm, and sustainable. They trade with a mindset that allows for growth, consistency, and clarity, regardless of fluctuations in short-term results. Your mindset defines the meaning of every signal you see in the market. And this truth reaches into every decision, every hesitation, every moment of confidence or confusion you experience as a trader. The chart is the same for everyone. The candles, levels, indicators, volatility, and structure are identical regardless of who is looking at them. Yet traders interpret these signals in completely different ways, and these interpretations shape their actions far more than the signals themselves. The market does not tell you what to do. It only presents information. It is your mindset, your beliefs, expectations, experiences, fears, and assumptions that gives that information meaning. Understanding this is essential because it shifts responsibility from the market to the trader. You realize that consistency depends not on better signals, but on cultivating a mindset capable of reading those signals objectively. Every trader views the market through a psychological filter. This filter is shaped by past wins and losses, emotional wounds, moments of regret, moments of triumph, and all the beliefs absorbed over time about what trading should be. Two traders can watch the same candle pattern. One sees opportunity, the other sees danger. One sees a breakout, the other sees a trap. The pattern hasn't changed, only the internal lens has. When the mind is influenced by fear, signals appear threatening. When influenced by greed, they appear promising. When influenced by hope, signals are exaggerated. When influenced by frustration, signals seem unreliable. The mindset transforms neutral market information into emotional narratives, and these narratives often lead traders away from objectivity. Your beliefs about the market determine what you perceive as valid. If you believe trends are trustworthy, you will interpret continuation signs with confidence. If you believe the market is manipulated, you will distrust breakouts and hesitate even when your strategy confirms them. If you believe you frequently lose, you may subconsciously seek evidence to validate this belief by interpreting signals negatively or entering trades too cautiously. The mind tends to interpret information in ways that confirm its beliefs. This psychological tendency affects every trading decision. And unless you consciously reshape these beliefs, the market signals will always appear distorted through your personal meaning system. The mindset also affects how you interpret risk. Traders with a fear-based mindset see risk everywhere. They exaggerate the potential downside of a valid setup, causing hesitation or avoidance. Traders with a reckless mindset underestimate risk. Overconfidence makes weak signals appear strong, and the focus shifts from probabilities to wishful thinking. The interpretation of risk becomes emotional instead of analytical. Neutral signals, like a pullback or consolidation, take on exaggerated meaning depending on the internal emotional state of the trader. Your mindset also determines the emotional weight you assign to signals. An emotionally reactive trader sees the market through a fluctuating emotional lens. After a loss, signals appear dangerous. After a win, signals appear safer than they really are. This inconsistency leads to large variations in behavior. The same setup taken confidently on one day might be avoided the next simply because the trader's emotional state is different. When emotions drive interpretation, technical signals lose their reliability simply because the trader is no longer seeing them objectively. One of the most powerful ways mindset influences signal interpretation is through expectation. When a trader expects the market to move in a particular direction, they filter every signal to support that expectation. They ignore signs of reversal because they feel attached to the initial idea. They hold losing positions because they interpret small pullbacks as continuation signs. They force trades because they believe a move should happen. Expectations create blind spots. They prevent the trader from seeing what is actually happening in the market. This is why traders often say, "I knew what I should have done, but I didn't act on it." The knowledge was there, but the mindset blocked it. Mindset also shapes how traders respond to uncertainty. Trading is inherently uncertain. No signal guarantees an outcome. A trader with a healthy mindset accepts this uncertainty and reads signals based on probability, not hope. A trader with an unhealthy mindset seeks certainty in every signal. They want confirmation after confirmation before committing. They overanalyze, second guess, and wait for the market to remove uncertainty, which it never will. As a result, they enter too late, miss opportunities, or become paralyzed. The desire for certainty distorts the meaning of signals because the trader searches for impossible clarity. Another way mindset influences signal interpretation is through personal narrative. Traders often create stories around market conditions. The market always reverses on me. My timing is always wrong. Breakouts never work. This setup always fails. These narratives shape expectation, and expectation shapes interpretation. A trader who believes breakouts fail will see weakness even when a breakout is strong. A trader who believes they have bad luck will perceive danger even in clean patterns. The narrative becomes stronger than the chart itself. The meaning is no longer derived from the signal, it is derived from the story the trader tells themselves. Mindset also controls attention. When your mind is calm, you notice subtle details in price action, momentum shifts, diminishing volatility, emerging patterns. When your mind is stressed or emotional, attention narrows. You miss key signals or focus excessively on irrelevant details. You might obsess over one indicator while ignoring volume or structure. The chart becomes a fragmented view rather than a holistic picture. Attention determines what you notice, and what you notice determines how you interpret the signal. This means the quality of your mental state directly affects the quality of your analysis. Even confidence plays a role in meaning. A confident trader interprets signals with clarity and consistency. They trust their rules and edge, so their interpretation stays aligned with their system. A trader lacking confidence constantly questions what they see. They doubt valid signals, misread strength as weakness, and second-guess themselves. Their interpretation becomes unstable, and instability leads to hesitation or impulsive reactions. Confidence is not about certainty, it is about trust in the process. Without it, signals lose their meaning because the trader cannot commit to the interpretation. Your mindset also determines how you respond to conflicting signals. Markets often show mixed information. Some indicators suggest continuation, others suggest reversal. A strong mindset evaluates these signals objectively through the lens of the trading plan. A weak mindset magnifies whichever signals align with the trader's emotional state. If fearful, the trader focuses on bearish signals even in an uptrend. If greedy, the trader focuses on bullish signals even during weakness. The interpretation becomes emotional, not analytical. Ultimately, your mindset is the lens through which every signal is read. It determines whether you see opportunities or threats, whether you trust your edge or doubt it, whether you follow your plan or react impulsively. It determines whether the same candle pattern becomes a setup or a warning. When you realize that the market does not define the meaning of signals, you gain the power to reshape your trading experience by reshaping your mindset.